Hi, this is Don Durrett, Gold Stock Data. I'm going to give you a long video on explaining various ways to invest in gold and silver mining stocks. I have another video on how to value gold and silver mining stocks, but this is more a little bit more in depth in analysis and some other factors that I haven't covered before. So there's 44 slides. I'm thinking it's going to take at least 2 hours. So I'm going to probably break it into 2 or 3 parts. So let's begin. The first way to invest in gold and silver miners is ETFs. This is the easiest way to invest because ETFs act just like a stock, so they're easy to buy and sell. The premiums are generally pretty low. It's usually like 0.5% a year, sometimes less than that, 0.25% a year. Plus, the ETFs are managed, so they're professionally managed, and reduces the risk because it's a basket of stocks and they have low allocations. It's a lot like a mutual fund, although mutual funds get valued only once a day, whereas ETFs value throughout the day. Plus ETFs, you can short them, you can do options on them, which you can't do with mutual funds. So we have GDX, which is the large cap ETF. I forget how many, there's like 30 or 40 stocks, maybe more in GDX. And there's not very many that are, say, under 500 million market caps. Most of them are over 1 billion. So it's basically large caps. There's some royalty companies in there. There's not very many silver miners. I know the large silver miners like Pan American's in there, Heckler's in there, Coors in there, but there's not a lot of silver stocks. It's heavily weighted towards gold. GDXJ used to be, when it first came out, had a lot of juniors stocks in there, say 100 million, 200 million, 300 million. Now those are becoming pretty rare. GDXJ had a problem in 2016 and it dropped, I forget how much, around 15%, very short period of time, because they had to sell a bunch of shares because they owned more than 10%, because it basically got really popular in 2016 when the price of gold went up. So now it's very similar to GDX. They're both mainly large cap. There's two other ETFs, GOEX and GOAU, that are more towards the mid caps. And GOAU has a lot of royalty as well, but not as many majors. So those are kind of your four gold. And there's some more. There's some Sprott Asset Management has one. There's a few other ETFs for gold miners. And then silver, the two main ones is, actually, I'm not sure if Sprott has a silver one or not, or can't really think of a third one. It's kind of popular. There probably is another one out there. SIL, these all trade in the U.S., so I'm not sure if they trade internationally. SIL is more. It has more large caps than SILJ. SILJ is kind of juniors. SILJ outperforms SIL because it pretty much has all of the silver miners in it, whereas SIL focuses mainly on the producers in the larger exploration plays and the larger development plays. I think both of these, since there's not that many silver producers out there, they kind of both make sense. So you can look and see what the differences is. Okay, if you pick your own stocks, these funds can be difficult to outperform. So, these are basically a basket. It's kind of like an index. But the one thing is they have risk. I mean, if you're going to have high allocations in these, you never know. Whereas if you pick your own, if you create your own ETF, basically your own portfolio, you have more control over it. Whereas that, let's say you pick 20 silver mining stocks, you might not outperform SILJ, but you have more control over it. And so it's I don't like to have, just a huge allocation in in these. I'd rather kind of create my own portfolio and then add these into it as well to create a little bit of diversification. I think these all make sense for diversification. So you can have, because the risk reward in the ETFs is pretty good, but it's not fantastic. Benefits, they trade just like a stock, which I mentioned. Um, Lower risk than individual stocks, but maybe not necessarily lower risk than a portfolio. They have low fees, 0.5, 0.3, 0.25, so it depends. Low premiums, and they're very liquid. Drawbacks, not every country, depending where you're at, will have access to these ETFs. Some, I mentioned the large position, some investors don't like to have large positions in a particular ETF, so that makes it hard if you're only going to do ETFs. You have to pay annual fees, but they're usually low, and you don't notice it. It's just the value of the stock will drop when they take the fees out. But it's with ETFs, it's not really that noticeable. But over, if you hold it for 10 years, maybe it can be an issue. Some people don't like ETFs for that reason. You only have a limited number to pick from. There's not a lot of choices out there. They might not meet your investments, and the dividends tend to be low. If you really don't buy ETFs for income per se, you really want to go more with the mutual funds, which we'll talk about those. You will get dividends, and they could go up as the price of gold goes up, but historically, they tend to be lower than, say, mutual funds. So, okay, gold mutual funds. Currently, there are no silver mutual funds, and the reason why is there's just not enough. Large caps and large mid tiers. There's only 18 silver miners that produce more than 1 million ounces. So, you're only looking at maybe 10 large silver miners. So no one's tried to do a mutual fund. They mix them, but just all silver companies are currently there aren't any. That's why SIL and SIJ are kind of unique. Typically mutual fund, like an ETF, has about 30 to 50 stocks in it. Some of these funds include silver miners. Some do not, so you have to check. Some of them include platinum and palladium, so check the prospectus. Benefits, professionally managed, which lowers the risk for you. Can be good income stocks. The one thing I like about mutual funds, which I didn't originally, is they pay out annually any gains, any capital gains, and any dividends. You can reinvest it, but you have to pay the taxes on it annually. But it makes for a good income stock. So let's say that you have a gold mutual fund and it goes up 25% in 1 year. You get paid that 25% that year. So it's basically a good income stock. So you get paid out annually instead of over time. So you don't get, it's a short-term capital gain. It's not a long-term. So some people consider that as a negative, but that's the benefit of a mutual fund, is like the income. You can get a really good check every, if it's a good year, like I said, it goes up 25, 30% in a year, you can get a really good check at the end of the year. And the dividends tend to be pretty good as well. They tend to focus on them. They trade just like stocks, although they don't price like stocks. They get priced at the end of the day. The NAV doesn't update during the day. If you buy a stock during the day, you actually pay what it ends up at the end of the day. So if you buy in the morning and then it goes up or down during the day, it's whatever it ends at. They tend to be highly liquid, just like a stock. The drawbacks, high premiums. They're usually, the premiums are usually around 5%, whereas an ETF, the premiums are tiny, like 1% or less. So if you buy a mutual fund, you need to go up 5% to break even. Some people don't like that. And they also have high annual fees, at least 1.5%, sometimes 2.5%. So those two factors right there is like, well, I don't want them. And that's why a lot of people say, I don't want mutual funds. I don't want to pay those high fees, annual fees of 1.5%, 2%. No, thank you. But from an incomes perspective, if you like income, I think they make a lot of sense. I have 3 gold mutual funds, and they pay out in December and right at the year end. And I actually like getting that income. I like, it's like I originally I didn't like it when I actually bought my first mutual fund. I didn't realize that they didn't have long-term capital gains, that they paid out annually. I said, what? I don't, I want this thing to get big, but then I got used to those checks every year, and now I like it. They may not match your investment objectives. That's like an ETF. And you have to pay taxes annually. It says pay capital gains annually, but that's a short-term capital gains, not long-term. Even if you reinvest the gains, you have to pay it. One thing you have to be aware of is if a mutual fund loses money, they can have a carryover loss. If it's a bad year, and then that payout can drop for the next couple of years where you won't get paid. That's one of the negatives that I learned about mutual funds, is this carryover loss. In other words, you don't benefit from the carryover loss, the fund benefits. And so I thought that's kind of messed up. You will benefit if your NAV goes down, and then if you sell at a loss, of course. But the tax losses for the company, it actually benefits them, that carryover loss. It probably benefits you in some degree, in some way, but that's just something to be aware of. You might check to see if you're going to buy a mutual fund, check to see if it does have a carryover loss. Okay, so now we're going to go to stocks. So those were your ETFs and your mutual funds. I'm not going to talk about bullion, but now we're going to talk a lot about stocks. So these are GSD is gold stock data. So these are the categories that I created for the website. So we have a major. We're going to talk about each of these categories, the risk levels and what to look for and stuff like that. Majors. So I use a different definition. In the industry, a major, a large cap company is more than 10 billion. But I designate a major as greater than 3 billion. I just think that once a company has more than 3 billion market cap, it's a strong company. So I'm just going to label them as a major. And it works somewhat out. For instance, the industry, the way that they label companies majors, I tend to label some majors that are not. Some people, they're considered mid-tiers, but I have them labeled as a major. For instance, Hecla Mining, that's considered a mid-tier in the industry, but their market cap is over 3 billion, so I have them currently as a major. So that's kind of the difference. Emerging majors, for me, an emerging major is a market cap between 1.5 billion and 3 billion. And then a mid-tier, this is the only category that's kind of loose for me. What I mean is loose is that I could put companies in here that maybe people don't think that are mid-tier. So I have market cap 300 million to 1.5 billion. That is just a kind of a generalization because I go lower than 300 million. Or it has production greater than 800,000 ounces, or silver greater than 3 million. So this is this or. So there's a lot of companies that have 880,000 ounces of production, but their market caps are less than 300 million. And I go ahead and label them that because if the price of gold or silver goes up, they're going to have a lot of cash flow and it's going to be a strong company. Then I don't consider them a junior. So then all these J's, these are the juniors. So I've broken juniors in all these different groups. So J, emerging mid-tier. So production is forecasted to exceed 80,000 or 3 million in the next 3 years. So here I'm not looking at market cap. I'm just looking at forecasted production. And these are existing producers. So these aren't small producers. These are producers that are going to grow their production. Small producers is a producer that does not qualify as an emerging. So, and then from here up, these are all producers. And so we have a small producers, and then we have small producers that are basically I think, going to turn into a mid-tier. Then we have a near-term producer, and these are companies that I'm forecasting to begin production within 2 years. Late-stage development, Again, I'm forecasting them to begin production within 3 to 6 years. This is a little, I said that mid-tiers is the only one that's kind of loose, but this one here, I could go all the way out to 7 years, but I don't do it very often. It's usually I like, it says within 2. So yeah, if they're not going to be in production, this is kind of most of the late stage companies that I have in there should begin production with 3 to 6. Some of them won't make it, if you will. I'll put it that way. These next 2 categories I don't use that much. I created them, but I don't use them. These are companies that are not exploration. These are not project generators. So these are development companies that are not late stage. So if I have a company that they basically call themselves development, but they're not late stage, then I'll stick them in one of these. There's not a lot of companies that kind of fit that. And it really comes down to how much resources they have. If they have a lot of resources and practically no resources, then I'll stick them here. Or or I might put them down here in potential exist if they don't have any resources and they call themselves a development company. But these are kind of outliers. Most of the stocks don't fit. You don't see a lot of these, and you don't see a lot of potential exist. The big category is your exploration company, which I call project generator. And the reason why is because they have no plans to mine gold. All they plan to do is basically find gold in the ground and then sell that property or option it out. And so they're trying to create projects. They're trying to create mines, but they're not going to mine it. So they're project generators. I consider a mine, basically a project because you have to develop the mine. And then the last one is the royalty company. And I have here owns royalty streams, but that could also be an NSR, which you could consider a stream. But now a lot of the lingo is you wouldn't necessarily call an NSR a stream. A stream is more as if when you loan money out and then you get paid back through some of the gold that they produce. That was kind of an income stream, a royalty stream. Whereas an NSR is when you have a percentage of the gross revenue, like it can go all the way down to 0.5% and all the way up to like 5%. The average is about 2%, 2% NSR. So if you get 10% gross revenue, it's a pretty good income stream depending on how much revenue there are. But royalty companies, we're going to be talking about those. Okay, now we're going to get into valuations. How to value a company and the various factors, what makes a company exciting or, interesting, or you want to potentially invest in it. So the part one, the first thing, these don't necessarily go in order. You could look at these other parts, locations, for instance, or so this is location. The balance sheet, stuff like that. Management could come before properties. I just label it one. Okay, so the size of the properties I have here, bigger the better. And the reason why is because if you have a big property, there's more potential for exploration on that property. There's really no downside to having 100,000 acres versus 10,000 acres. In my opinion, I don't see the downside. So that's why I say the bigger the better. And if it's a small property, that becomes problematic for me. So I don't really want to see anything that's like 500 hectares or less. 500 hectares isn't terrible, but I don't really like to see 500. If it's an underground mine and it's on 100 hectares or 500 hectares, it's not necessarily terrible. But if it's a surface mine and it's 500 hectares, I don't really like it. So I like to see at least 1,000 hectares. And once it gets to 3,000 or 5,000, I'm much more comfortable. So anything that's under 1,000 just kind of makes me kind of nervous because there's just not going to be a lot of exploration potential per se. Size of the resources, I have this on a separate slide. Location, Location is always critical, of course. It's one of the first things you look at. Ideally, I prefer companies in Canada or Australia. And then after that, the risk starts to go up. Because the reasons why I say that is because Canada and Australia, they treat their miners kind of like the US treats their farmers. They kind of take care of them. And it's not across the board. There's always going to be certain locations that can be problematic politically. They don't get a free pass everywhere. But on the whole, it's kind of a national industry in those two countries. So political risk is always one of the most important reasons why you look at location. It's becoming more and more of a political hot potato in just about any country. Mine. It can have environmental issues, and it can damage the water supply, and that's for one issue, and always be an eyesore for open pits, of course. And those are kind of the two main ones: is environmental and ecological. Those are the big political risk. And the other political risk is national ownership. So you have countries, and this is a big risk in Mexico, for instance, where Mexico owns so much silver, and most of it is owned by foreigners. So it's like, wait a minute, that country is going to they're either going to in the future, they're either going to raise the taxes or potentially nationalize some mines or all the mines. I mean, the one thing that we've seen is countries, they will nationalize only a few mines. They won't nationalize all of them. But over time, they're probably going to nationalize them all. And so that becomes, that's the other part of political risk. Infrastructure. So you always want to find a mine that's either well, ideally you want to find a mine that's in an existing mining district. If it's not in an existing mining district, then you want it near another mine, either that's currently producing or is produced recently. If a mine is basically an orphan in the middle of nowhere, then you're going to have potentially going to have infrastructure issues. But if a mine's already existed there, then those infrastructures have been somewhat tackled in the past, especially if it's a mining district. Like these mining districts in Canada are just so ideal because the infrastructure is just, really, really good. And there's so much mining in, for instance, Mexico. They generally have good infrastructures about anywhere in that country. Mining friendly, this is becoming more rare, if you will, for countries to be mining friendly. So it's becoming tougher and tougher to find, and mining friendly is changing all the time now. It's like you think a country is mining friendly, and the next thing you know, something in a negative manner is happening. So this term is becoming less and less applicable across the board. Nearby mine. This is where I mentioned the infrastructure. You want to find mines that are near other mines. Local issues. Local issues is basically political issues that have happened in the past. For instance, we've had a lot of protest, and so you can know if you're investing in a company that the property that has there's been protests nearby, then that could come over into your property as well. What kind of political issues have occurred in that area? So that's something you need to do some research on. Okay, cost. That's going to be a separate slide. Recovery rate. So I have here 50% is low and 95% is high. So I really don't want, this. I'm talking about properties, but this goes into deposits as well. But part of this is kind of the ore on the property. So I really don't like to see recovery rates below 50, and 50 kind of doesn't really give me a real good feeling. I prefer recovery rates of at least 80%, and 95% is fantastic. 90% is fantastic. Once you get below 80, it kind of starts to get into the marginal because it starts to impact how much gold or silver is going to be recovered. And so you want to always look at the recovery rates. And so anything below 70 is basically gets into the low. So 50 to 70 is kind of low. Is 70 somewhat, 70 is marginal, if you will. I would say 65 is low. That's something you're always going to look at. And every mine's going to have its own recovery rate, and recovery rate's always going to be told. They're always going to tell you what it is. That's part of the PEA. It's part of the the pre-feasibility, and it's part of the estimate of the resource. Okay, drill holes. We're going to do that on a separate side. Grade. We're going to do that on a separate side. Ownership. Ideally, you want to see the properties 100% owned, but they not always are, especially in a lot of these foreign countries. The countries will say have a mandatory 10% or 20% ownership. And then a lot of the times there's JV partnerships, which so common in gold mining. So JV partnerships, I really don't like to go below 25%, and ideally I like to be 50% JV is ideal. I mean, that's the most you can get, a 50-50 partnership. But 30 or 40 is good, but you see a lot of 25, 20, 25, and 30s is common with these with project generators. That's how much they'll keep. And then insider ownership. I like to see the management at least own 5%. You don't always see that in the larger companies, but in the explorations you see that quite a bit. So if you have like the CEO's 5%, the board, and if it's a combined more than 10%, that's really good, because then they have skin in the game, and then they kind of think twice about how much they're going to dilute, because every time they dilute, their ownership drops unless they buy in. And ideally on insiders, I like to see at least 25% on exploration and development plays, so that they don't get taken out on a hostile takeover, or the insiders, there's kind of peer pressure. It's like, wait a minute, there's some of the peers are going, I don't want to give this thing away for a 40% premium. Let's hold on to it. So the more insiders you have, the more likely it is that they're not going to sell, early, if you will. They're going to talk about it. What is this thing really worth? So if you have insiders that are below 20%, it becomes very likely that these companies, the developers and the exploration companies tend to get taken out once they discover something. Once their companies are really cheap, very undervalued. Exploration potential. So you want the properties, you want to see, what type of drill potential do they have? What is the pipeline? What are they telling you? A lot of times, like, they'll have surface samples of a historical drilling. You want to know, exactly what is the potential of this company. I mean, that's really what gives you a lot of excitement. It's like, because the companies are not valued on what they currently have. Well, that's all they're valued on, the goal that they currently have shown you, but they're not getting valued on potential. So if you can see the potential, then you can see how undervalued they are. Mine life is really important, because once a company, their mine life, if they're a producer, and even if they're a developer and all they can show is a short mine life, no one's going to be the value is going to get hurt. So what is short and long? In my opinion, you really want everything about 8 years or longer. And ideally, I like to see 10 plus. So 8 is marginal. Anything less than 8 is short. So if you go to 7 and less, that's kind of short term. And 7 or less is okay as long as you have exploration potential. But if you have like a 7 or less and there's no exploration potential, and that mine's going to get shut down, the closer it gets to shut down, the more it's going to impact that share price. So ideally, you want to see all the mines more than 10 years. More than 8 is, that's okay. It's kind of marginal. But once it drops, you got to realize that if they're at 8 and it goes to 7, it goes to 6, it goes to 5, at a certain point that stock's going to get hit. So be aware of that. So cost. So cash cost per ounce. this is the operating cost, and the companies are going to tell you what their cash costs are, and it's going to be a fairly accurate number. And ideally, you want it to be 1/3 of the spot price. So if you're at $1,800 gold, you'd like to see 600. That would be low. That would be a low gold price. 1/3 of spot. And then if it was 2/3 of spot, then it would be $1,200, which would be high. And so, right in between that, 800-900 is that's kind of the marginal area. I would say 800 is fine, but once you get to 900, 1,000, that's really marginal. And then once you get to 1,100, 1,200, that's high. So it's like 1/3 of spot, 2/3 of spot. And I've seen over the years that usually holds pretty true. And that's really what you want to do. So you want to avoid the high. Marginal is, is okay, but you got to be careful. It's like the only time you really want to go marginal is if they have a lot going for them, like exploration potential, good management team, long life mine. So that all comes into play. And then even the low prices, the low spot, I mean, that looks great, of course, but there's other factors that come into play. And I mentioned that is generally reliable. So when the company says, okay, this is what our cash costs are, it's usually fairly close. ASIC, this is the all-in cost, and it basically ignores certain costs, such as exploration and development, which can be significant. Since it ignores certain costs, it's unreliable and misleading, and always understates the break-even cost per ounce. So for me, as far as I'm concerned, the only thing that matters to me is the break-even cost. That to me is the all-in cost. So I ignore the ASIC, which is an accounting number, which again ignores a lot of costs. And you will never find a company who has an ASIC that is the same as the break-even cost. The closest you will find is a company that has really high production, say 1 million ounces of gold a year, and they have no debt. Then you will have the AIC will be somewhat close to their break even will be somewhat close, and they're not doing exploration development, very little. But other than that, it's usually always you're going to need to pad it significantly. No, I don't know if significant is the right word, but you have to pad it somewhat. And I've learned that for gold, it's usually you're going to pad it around $200 an ounce, whatever this is, and for silver, it's about $5, somewhere in there. But padding is one way to do it, but the other way to do it is what I'm going to talk about here. So this is the all-in cost per ounce, the break-even cost. So this is what I use to determine the free cash flow. So you have production ounces times the spot price minus the all-in cost. That's going to be the free cash flow if you have a correct all-in cost. Again, this is free cash flow, so that means the all-in cost includes taxes. It includes everything, and taxes aren't part of up here as well. So here's an example. So we have the gross profit. This is how I calculate gross profit. It says GSD gross profit. So I take the net profit, whatever, this is a producer, and I remove their exploration and development cost. And there might be financial cost as well in there, but this is basically a ballpark. How much money they're going to spend on CapEx and how much they're going to spend on development. And then I come up with my gross profit. And then the net profit. So I have 10 million. Okay, so this is the net profit. So I have 10 million in net profit minus exploration 2 million equals 8 million. So my gross profit is 8 million. So then I have my revenue, which is 20 million, minus the gross profit equals the all-in cost, which is $12 million. And then from the 12 million, I can calculate what the percentage of revenue that is. So my total costs were 12 million, which is 60% of revenue. So then if I take 40% of the spot price, that's going to be my cost. So the revenue, it was 40%. So revenue was 60, so my cost was 40. So 40% of the spot price of I'm using 1800 as an example, is 1080. So this is the all-in cost per ounce, the 1080. So this is how you calculate. And then if you go and you look, so over time I've done this, then if you go and compare this 1080 to the all-in cost, you'll find, depending on how much they produce, the more they produce, the padding is a little bit less. But the padding, you'll find that the padding is going to be anywhere from, say, $300, $100 to $300, what they say that their all-in cost is, you know. So, and you'll learn that. So then you can learn how to do the padding. But this works out pretty well for calculating your break-even cost. So I'm not trying to be perfect here. I'm just trying to determine the free cash flow, the future free cash flow, or the current. This is actually current, but you can also do future as well. I do both. Okay, so people. Some investors consider this to be the most important factor for a company. I think that is true for a late stage development company who's going to try to, build a mine and, put it in production. It's also very important for, say, small mid-tier producers that are trying to grow, because growth is very difficult to do, and hitting your numbers, it's like, it's just tough. It's a tough business. So anywhere, any development company or small mid-tier company, management is just crucial for those companies to be highly successful. The other end of the spectrum is your exploration companies. I mean, the geologist can be more important than the CEO. Now, the CEOs, they can be perpetual money printers. So they can issue shares and just keep raising money. A lot of these companies will issue shares every year, and some of them do it 2 and 3 times, these exploration companies. So they basically dilute into the ground. They're just trying to find gold so they can sell it and then they can get paid, and they're not really shareholder friendly. So you have to watch for companies that are doing a lot of dilution. But other than that, dilution's key. But the geologist and the property can be kind of more important than the management team per se on the low end. But then, and then again on the high end, once you get a company with, say, a mid-tier producer with a market cap of, say, over $500 million, and the higher you go, 1 billion, 2 billion, the management teams tend to be pretty good. You will run into a few of them that are kind of perpetual. They're not as shareholder friendly as some of the others, and you'll come to learn this. For instance, like Hecla Mining and Core Mining, I always call them like twins. They tend to be perpetual borrowers, perpetual growers. They buy a lot of projects. They put a lot of debt on their balance sheet, and it never kind of catches up where the shareholders win, if you will. The only time those companies tend to do really well is during bull markets, but during bear markets, not so well. But they have good management teams, but it's their strategies. Their strategies are not conducive, if you will, for during bear markets or non-bull markets, if you will, to do extremely well. So you have to look out for those kind of manager teams. You really want to find manager teams like First Majestic, who kind of go out of their way to tell you that they're focused. They're focused on the shareholder and that they're cash focused. Okay, so have they done it before? And this is really about development companies. What is their record? I've seen it time and time again where you have like an accountant be the CEO, and it's like, wait a minute, how is a CEO that is an accountant going to build a mine? This is a tough business. You really want somebody who's built a mine before. If it's their first mine, you better cross your fingers. Basically, it's not an easy business. So they need a track record. You want to beware of CEOs and chairmen of the board with no record. I just mentioned that. The guys at the very top need to have a bit of a track record. I mentioned this before, exploration and development. I didn't say development stocks, but I will mention that now. But exploration companies tend to be money printers because, well, that they really don't have any choice. But they can be more aggressive or less aggressive on their exploration. And if they're very aggressive, they can just dilute significantly. Development stocks are always, and I'm gonna talk about them separately, the development companies, but they can be diluters as well. And even producers, you don't want to see producers doing dilution. They don't necessarily have to, but sometimes they do, just basically to protect themselves. I mean, because they can put 20 million in the bank. It's just, kind of protection. Okay, to try to determine if they are shareholder focused. One way you can do that is to see how much shares they have, how much skin in the game they have. And then the other way you can find out is to watch the CEO and see what he says and see if he basically kind of brags about being shareholder friendly. And very few of them do, you'll find out. And then, you just get a feel for, what are they out for themselves or are they out for shareholders? I just listened to, just today, I listened to a YouTube video and I couldn't believe the CEO. I mean, you could just tell everything that he was saying, that the focus was on him making money. It was amazing. I don't even think he realized what he was saying. How have they been executing the last 2 years? Yeah, you want to check their news releases. How are they executing? And this is something you will learn over time. You will learn by looking at the news releases to get a feel for their execution. What is the quality of their presentation? That's important. Is it up to date? Sometimes I like it when they're up to date. I mean, every month, the good companies, the ones that really do a good job, they update their presentations monthly, and they give guidance. And other companies, I mean, I've seen a lot of late stage companies just give pathetic guidance, and it's like, and it drives me nuts. And then the really good development companies, fantastic guidance. So that's important. Good management team should stick out. I mentioned watching the CEO in a video and see what he plans to do. Like I said, I was watching that video today of that CEO. I do own shares, but I doubt that I'm going to do is 100% return on that one. That's the way I feel about it. I probably should sell, but I'm hard-headed when it comes to that. I got to have even a better reason than that. Okay, so part 3, resources. So this one is resources. I probably should put it up at the top. So resources is really crucial. It's kind of like the location, and it's has the location's really crucial. So are the resources, because without resources, you're just not going to have cash flow. So it really comes down to what are the properties, exactly what do they have. I mean, this is the value of miners comes down to really two things: the price of gold and silver, and how much cash flow can they provide, or how much potential cash flow they can provide. And that comes from where? It comes from the resources. So you got to analyze that fairly significantly. The different types of resources. So we have P&P, which is proven and probable reserves. You have M&I, measured and indicated, and you have inferred. So what are the definitions of each one? So we have the P&P. They have been deemed to be economic by a third party through either a pre-feasibility or a feasibility study. These are M&I. So P&P comes from the M&I. M&I is the starting point. So an M&I is not economic. An M&I has just been found that's the grade. That's what they found. Those are the resources. The M&I is what a third party has said, okay, they have this. Then a P&P does a feasibility or a pre-feasibility and says, okay, this M&I or a percentage of it is economic, and those become reserves. Those are what a reserve is, just an economic resource, basically. Pretty simple stuff. And now, again, I mentioned M&I is gold in the ground or silver in the ground that's deemed to be reliable, based on, by a third party using the drill results. So a company will drill a whole bunch of drill results and then hand those drill results over to a third party, and the third party will say, okay, this is the M&I, this is what you found, and then this is the inferred. So the inferred is deemed to be unreliable, or let's just say it's not deemed to be reliable. Not enough. It doesn't have enough drill results to be reliable, that I can tell you that that gold's there, if you will. It's just inferred to be there. Now, inferred usually comes from the resource estimate, but it can also come from management, just basically saying, the geology based on my drill holes, there's basically probably 1 million ounces there. And now they might not necessarily, they might only verbally say that, but so inferred doesn't necessarily have to come from drill results, although it normally does. But sometimes I will actually give a company inferred resources just based on the initial drill results, based on the geology. You can just kind of infer it out that they're going to find more. And if they're finding, fantastic drill holes and they've only drilled, 20% of this strike and it's the same geology, then you can basically infer it yourself. Now, historical resources, they're kind of a gray area. These are resources that have been, they were in the company before them, or even the company before them had a company do, but they're no longer considered M&I or PMP. They're just historical. And so, but some historical, depending on how long ago, they were, deemed reliable. So a lot of times the length, and so you'll see a lot of historical resources, and those were based on third-party analysis. But again, they're no longer, because time has went by and now it's a new company. So generally what happens is when it shifts from one company to the next, they have to go out and kind of redo it, depending on how long ago it was. If a company buys a company, but if a company, like kind of goes bankrupt and that property just sits there forever, and somebody comes in and buys it, then at that point they're called historical. Again, it's kind of a timeline thing, but you'll see historical a lot. I actually think that inferred is actually kind of more reliable than historical. These are kind of one level below. These need to be validated, if you will, to some degree. We can need some drill holes or whatever. So that's historical. Grade usually determines the quality of the resources, and I have a slide where I'm going to show you. It's kind of a reference chart on how to identify grade, good grade, poor grade, excellent grade, stuff like that. So I'll show you that slide if you can if you can last long enough. So we're on slide 9. We got to go to 44. So this is a long presentation. You can think of it as a class. Low grades are dependent on offset metals. It's something you always need to be aware of. If you're bullish these offset metals, then you can rely on them. Me, I'm not so bullish, so I kind of get nervous when I see that they're relying on these offsets for their low cost. Right now, we're going into a bull market for commodities, and so these offsets are actually going to should help a lot of these miners. So me being conservative, and some of my stocks that I've been conservative with will probably do better than I anticipated. A lot of times I will not include these offsets in their resources, but I will include some of it for lower cost. But you have to be wary of companies that list their resources in either AUEQ, this is gold equivalent, or AGEQ, because sometimes it's not necessarily economic with only the gold or silver. It's dependent on these offsets. So you need to be aware of that. Resource valuations. estimating future reserves. So yeah, so how much will they mine? So I always do, I always estimate their future reserves in order to identify future cash flow. So I estimated myself, and this is something you can do as well, because I want to use future cash flow to compare, um, to get an idea of the valuations, the value of their current value of the resources and their future value of the resources. So I'm going to calculate how much their current resources are worth per ounce. And I'm going to value that versus their current market cap. And then I'm going to calculate their future reserves, how much they're worth per ounce versus the current market cap. It gives me valuations of the resources. So a quality major's their current reserves will be worth around $500, and a current exploration is only worth about 100, and a mid-tier is worth about 250. And so you have these are, strong producers, and it can go higher than this. This is the average. You can see producers up there, $800 an ounce, somewhere in there, and you can see mid tiers all the way up to as much as 500. So you can find gold in the ground for $25 if you're a producer, and then it can be valued all the way up to 500 or more. So you see, I mean, like a mid tier, if they can find gold for 25, I mean, 10x, it can be worth 10x that. So exploration is just a huge leverage for these companies. Every ounce that they add to their reserves is going to add a lot of money. So you can see where exploration really comes into play. So if you can, so now we get into, okay, this is what they're worth. So if you can buy, if you can find companies that are worth less than that, so if you can buy a gold in the ground from a major for like $100, that's pretty cheap. So you have these sell-offs. These companies, they'll have a problem and they'll get cheap, and so a major, if you can find one that's currently valued at 100, that's pretty cheap, or a mid-tier at 50, I mean, you're basically looking at a 5-bagger. So I try to find gold on the ground currently valued, under 50. You're really not going to look at majors per se. Every once in a while, you'll see them drop down to 100, but majors, I'm really looking at majors more as like 3-baggers, not so much 5-baggers. But mid tiers and development stocks, you can find them for 50. So any gold company, if you can find quality resources for $25 an ounce, it's usually a bargain. And sometimes you can find gold in the ground for $10 per ounce. These are I call these optionality plays. So if you can find, I'm focusing on gold here, not silver, but if you can find gold in the ground for $10 an ounce or less, and it's a big resource, that's an optionality play because it can get revalued higher as the price of gold goes up. And we found this out last year. In 2020, we saw these optionality plays like in March. I mean, a lot of these companies were selling for valuations, of $10, $15 an ounce for gold in the ground, silver, $1 or less in the ground. And they just exploded in value because the price of gold and silver went up. And that's the optionality play. So you're looking at, around $10. And again, silver's, about, you can go 10x of this, so it's like $1, and then all the way up to 250 for silver. 1 to 250 is kind of really cheap. So that's kind of what you're looking at, the values in the ground. When you're looking at, we're looking at just resources. We're just kind of looking at, this was just kind of looking at current values of gold. Market cap. Okay, so market cap size matters. We have, so I like to look at, ideally, what I call the sweet spot. I said the sweet spot here. I like to look at companies valued somewhere between 50 and 200 million. And the reason why is because once you get to 50 million, the risk level starts to drop. When you're investing in companies under 50 million, that means they don't have a lot yet. It's all based on speculation. Those are kind of speculation stocks. But once you get to 50 million, the speculation starts to drop, because in order for a company to be worth 50 million, they have to have something. And so what do they have? Is it an exploration? If it's an exploration play, that means they've had good drill results. And then you can just you're just betting on more good drill results. If it's a development play, then it becomes a combination of exploration and future potential cash flow. And then you're looking at like a potential mid-tier story, or you're looking at a cheap mid-tier under 200 million. But this is really the area that I like to focus on. I will buy some under 50 and I will buy over 200, but for different reasons. The one under 50, those are just speculation bets going for like a 10 bagger. And then over 200 million, you're going more for diversification. You're looking at like 3 and 4 baggers with potential 5 bagger, but maybe not always. But it's more, you're really going for that diversification when you go over 200. The sweet spots for your 5 bagger is really your 500 to 200 million. And that's where I really get excited finding companies in that area. And the one thing you'll find is, once you get over 100 million, especially in development stock, they're really starting to get closer to production, or could be a mid-tier that's starting to break out, like they're building their second mine or they're expanding production. Lots of different stories really between the 50 and 200 million. So it says many investors chase microcap exploration stocks looking for quick returns. So true, and that's the under 50 million area again. People are always looking for that potential, 10 bagger or 10 plus bagger, but these can have atrocious risk reward profiles because you're totally reliant on them finding more gold. And so, I mean, you can get lucky and they can, but again, the risk reward is not always great, and you have to be careful. That's why Eric Sprott owns a lot of exploration plays, because he knows he only needs to find a few that are big winners. They don't all have to be big winners, but the only way he's going to find a lot of big winners to own a lot of stocks. And so I always say to only invest in stocks that have the goods. So they have the goods. In other words, they have produced good real results already. And I'm going to show you what a good drill result are. If they haven't produced good drill results, then what are you doing owning that stock? That's the way that I look at it. And you also want to keep your cost basis under 1% for these companies. If they're home runs, fine, but you just don't want to invest a lot in them. These are gambles, basically, total speculations. So keep it under 1%. Share structure. Ideally, you want to have a tight share structure. And when I say tight, I mean less than 100 million. Some people want to go like less than 50 million for tight, but they're just rare. It's becoming very rare. So I'm happy under 100 million, but that's ideal. And the reason why is because they're more explosive the tighter the share structure is, and the more explosive they are, it's kind of psychological. So I say here, what are the problems with large share structures? Well, the first one is they have potential to do a reverse split, and trust me, from history, reverse splits tend to be ugly. So let's say that a company gets up to like 800 million shares, and then they do a 10-to-1 reverse split, take it from 800 down to 80, and then their share price goes down. Let's say it's out, 10 cents, and they did a 10%, it goes to $1. So now they have that dollar. What happens inevitably is people, it sells off, because then after they do that reverse splits, then they do an offering, and they basically raise money and they issue a bunch of shares. They dilute the shares. This is what they always do. They do the reverse split and then they issue shares. So it's at $1, and then they dilute, and then it drops down to, who knows, 50 cents. And then you were already, let's say you're underwater, and then it dropped another 50%. And now you can never catch up because they basically diluted. So the break even now is, who knows how high the share price has to go just to break even. So reverse splits are ugly, and that's one of the reasons why if you buy companies that don't have tie structure, like anything over 400 million, then you're having a potential for a reverse split. So that's one of the reasons you avoid these really high share structures to avoid these reverse splits. Reverse splits really are not so bad for producers, but for development and exploration plays, the reverse splits can be really nasty. The second one is the psychology. Investors do not like shares to go up slowly. So if you go from 1 cent to 2 cents, it goes up to 100%. Yeah, it looks fantastic. But psychologically, 1 cent to 2%, it doesn't get you too excited. But when a stock goes from $1 to $2, so let's say it goes over, this happens over a 1 month period. It goes from 1 cent to 1.2 cents and 1 cent to 1.3 cents. Is that getting anybody excited? No. But if it goes from 1 to 110 to 120 to 130, that gets people excited, especially when it goes from $1 to $1.20, 20% move. That gets people excited. So psychologically, those are the two reasons why share structure is kind of important. I'm going to do 15 slides at a time, I've decided. So I'm going to break it into 3 parts. So we got 3 more slides here, and then and I think the number 1 is probably going to be the longest, and the next 2 will be a little shorter. The first one's going to be about an hour, and then maybe we'll see how, the next 2 aren't going to be an hour each, I don't think. Okay, so this one, part 6, is the balance sheet. So cash debt. I do not like to see companies with a lot of debt and no cash. Of course, I mean, that's just ugly, right? Because that's what you're looking at, a potential bankruptcy situation. But a lot of companies they don't mind having debt. So you'll see companies with 100, 200, 300, all the way up to $1 billion in debt. And they and they never get rid of it. It's always on their balance sheet. They always have debt. And then they'll keep cash as well, 50 to 100, 200 million in cash, but they'll always have a net debt scenario. I don't like that. I want to see a net cash scenario. And ideally, I want to see no debt and a lot of cash. I want to see companies that have 100 million in cash and no debt. That's an ideal situation. It just gives them a strong balance sheet, and they get rewarded. Their share price gets rewarded. And if they do have debt, I want them to say, we're going to pay this off in 3 years. I want them to literally say that. So that we're cash focused. Yeah, we're going to borrow $200 million to build this mine, but we're going to pay it off in 3 years. That's what I want to see. I want to see a company that's cash focused. And the one thing about balance sheet is these companies, they can go bankrupt. If they're losing money and they have a lot of debt on it that they have to finance or that they have to pay off, the company has $100 million in debt, 10 million in cash, and they're only producing 50,000 ounces a year. That's not a good scenario. That's a company that could have problems, and that's a company that's going to get hit. Their share prices are going to get smacked. So, and you got to really watch that balance sheet. And in my book, I talk more about what to look for as far as the coverage ratio. It's like once you get over 50% net debt, over 50%, that's not good. So you got to look for kind of what the levels are. But okay, current liabilities. Look and see if the current liabilities are higher than their cash level. I don't like to see that. So you have a company that's got, 20 million in current liabilities, and then they got, 10 million in cash. That's a big problem. You can also look at, total liabilities versus cash, but I kind of like to look at the current liabilities. You want the cash to basically be like 5x current liabilities. So that's something you just to pay attention to. Convertible debt. This is often hidden because when you look at their overall debt versus like their overall share structure, because convertible debt can basically dilute shares if they have a lot of convertible debt. And that dilution is kind of, it basically is, it's an overhang on the value of the company if they have a lot of convertible debt. I don't like to see a lot of convertible debt because that's just dilution ready to happen, especially when companies go up in value. So you're investing in good companies, right? So they go up in value, and then they shareholders will convert that into shares. And yeah, the debt goes away, but the dilution's forever. That's the problem with convertible debt. I would rather have regular debt, that way we don't dilute shares. Use debt for leverage and then pay off your debt and keep your share structure low. Options, warrants. Okay, so um, I guess I give you a quick definition of both, right? So options are given to uh, basically usually given to management, given to employees or third parties, whereas warrants are um, basically give people the option to buy shares. So whenever they do a financing, they will give you free warrants. And then the warrants are the ability to basically buy the shares back. And so the combination, both of these are at certain levels. So when you give somebody options, you can't give them at the current share price. Same with warrants. They're always at a future price. So if the current price is $1, the option has to be higher, like $1, I don't know, I mean, $1. And they're basically usually into the future, like $1.10, $1.20, $1.30, $1.40 if the current share price, and then they expire. At a certain point, they'll expire. So if the share price doesn't go up above that, then they can't turn these into shares. Sometimes the options they will not vest. So if they'll give options to like the board members or the managers or employees, but they won't vest for like 2 years. So we'll give you options at $1.10, but you can't, even if the shares go up to $1.20 this year, you can't convert them into shares, not until they've vested. And then so they have expiration and they have and then they have vesting periods as well. Same with warrants, but you need to add all of these up to get your fully diluted shares. And if they turn into money, they will turn into cash because they turn into shares, right? And then investments. So the investments, these are when they hold shares in other companies. And I say these are often liquid because the investments in these other companies are shares. A lot of companies will own shares in other companies and they can sell them. And a lot of times those aren't, you have to look and see, those usually aren't part of their cash balance. So you have to make sure and add up, how many shares they hold of another company, because that really is, it's liquid. They can sell those shares. Okay, free cash flow income. A company with debt and no income has high risk. I think I mentioned that earlier when I was talking about the cash debt. Uh, Ideally, you do not want to see an exploration company with debt. Um, so free cash flow is only going to be from a producer. And so when you're a development story, you generally, or an exploration, unless you have an NSR or some type of cash flow coming in or some type of income coming in, you can check to see, do these companies have any free cash flow or any income? To know if they do not, then they're going to have to raise money. So you have to pay attention to that. Do they have any? And then that's something to look for as far as the balance sheet goes. The cash flow multiple. So you want to look to see what the company is currently valued at, and I have that in on my website. It actually shows you the current multiple and the future multiple. And so most of these companies are going to be valued somewhere between 3 and 20, actually all the way up to 3 and 30 with some of the royalty companies. Some of the lower ones, the 3 multiples, they usually don't go much lower than that. Most companies get valued at least 5, but you will see some go down to 3, and that's because of the location where they're at and their balance sheet. and the life of the mine. So if you have a short life of mine, a lot of debt, high cost, your cash flow multiple will drop. So, and so you want to look at that and see what they currently valued at. What's their current cash flow multiple? You want to know that. So a quality major we valued about 20 times free cash flow, and a quality mid-tier about 10. And then a quality small producer is about 5. And your average mid-tier is going to be, around at least 5, I would think, the average. And the average major is going to be around 15, maybe a little less than that, the average again. So that's your cash flow multiple. Acquisition target. So I want to do 2 more slides. I think we're hitting an hour here, so it's pretty long, but bear with me for 2 more slides if you can make it. So are they an acquisition target? So this is actually not a good thing, I don't think, and unless it's a producer and let's say you're up 300% or more, and you want to, because when a company gets taken out, you get a quick 30, 40, 50% return, which is not a terrible thing. Plus, like whoever took you over, your shares are going to roll into that company. So it might not be a terrible thing for a company in that situation. But if you're only up, say 100%, 200% or less, and you know that this company has a lot of upside potential, you don't want somebody to come in and steal that from you. You don't want to get taken out. But quite often, if you're in a situation where you're looking at a 3, 4, 5 plus bagger, then you're highly undervalued. So you become a target. And this happens quite often with companies that are very cheap because there's no path to production yet. And the reason why there's no path to production is because the price of gold or silver is just not high enough. And so it's really, really cheap, and you're just a sitting duck kind of thing. And the only thing that can really prevent that is the insider ownership. And I mentioned this earlier, you want to be around 25% insider ownership or higher to prevent these takeover attempts. And it seems like whenever there's low insider ownership and these companies are really cheap, seems like they always get approved. So the bad news is that the highly undervalued companies usually are acquired, because they just will be taken over. And so if you think you have found a wonderful investment, it will often be snatched away by a takeover. So that's why insider ownership is really important. You find these companies, wait a minute, this company's valued at $10 an ounce, at $15 an ounce, plus they have all this upside potential. They have all this exploration potential. I'm going to make an easy profit on this. And then, it doesn't always turn out that way. Okay, spin out policy. Exploration companies, project generator, prospect generator is another word that they use. They often use spin out policies, and this really frustrates me because what happens is every time that they find a mine, they spin it out, and the only thing that you get is like 25% of your shareholders go into the spin out, and then you retain 100% of the original company, which never goes anywhere, just spins in place. In other words, your investment in that company, that 100% in that company, it doesn't go to the spin out company. You only get 25% or 20%. Happens all the time. So who's benefiting on these spin out policies? It's the management team. So when they do that spin out, they get more of the spin out. They don't get the 25%. They get, more than that. You get this little 25% of your shareholder value, and but that's free. Well, I want the whole, and then, so I find that companies that have these spin out policies tend to be damaging to shareholders more than beneficial. It's rarely you see a 100% spin out of the quality project. It's even rare to see 50% spin out. So most of these exploration companies do the spin out policies, these project generators, it doesn't always work out great, if you will. So that's something to be aware of. But I prefer if it's a one property exploration company, and then they find this big, great discovery. Well, they can't spin that out. There's nothing to spin out. That's the only property they have. So if it goes up, 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 then you're going to get that whole return. And then when they finally do get bought out, or you're going to get your return. So I like the one. I'd prefer a one property exploration company versus 10, 20, 30 properties that's doing a spin out policy. Um, these have the effect of preventing company from growing. That's what I mean. Ideally, I load these policies and poison pills for growth. Okay, so I'm going to go ahead and stop it here, and then we'll take over on part 2. And thanks for sticking around.